Have you ever wondered how financial institutions decide who gets a loan? It's not as simple as it seems. Banks and other lenders have to consider a multitude of factors before they can approve a loan application. It's a cosmic dance of risk and reward. On one hand, they want to lend money to earn interest, but on the other hand, they must be cautious to avoid the pitfalls of loan defaults. Lenders want to offer loans, but they also need to be careful about defaults. A default can be a significant financial setback, not just for the lender but also for the borrower. This is where the power of prediction comes in. Predictive analytics has revolutionized the way lenders assess potential borrowers. By analyzing various factors, lenders try to predict which borrowers are more likely to repay their loans and which ones are not. These factors can include credit history, income level, employment status, and even social behaviors. But how do they do it? What tools and techniques do they use to make these predictions? The answer lies in sophisticated statistical models like Logit and Probit. These models help in estimating the probability of a borrower defaulting on a loan by analyzing historical data and identifying patterns. These models are continuously refined and improved to adapt to changing economic conditions and borrower behaviors. The goal is to minimize the risk of defaults while maximizing the number of successful loans. In the end, it's a delicate balance. Lenders must navigate the fine line between risk and reward, using data and analytics to guide their decisions. The better their predictions, the more stable the financial system becomes. Imagine flipping a coin heads or tails, a simple yes or no. That's a binary outcome. In the universe of loans, the binary outcome is whether a borrower will default or not. Will they repay their loan on time, or will they fail to make payments? Understanding this fundamental concept is crucial for unraveling the mysteries of Logit and Probit models. The Logit model, my friends, is a powerful tool. Think of it as a cosmic translator. It takes various factors like income, credit score, and loan amount, and converts them into a probability. This probability, ranging from 0 to 1, tells us the likelihood of a borrower defaulting. A higher probability means a higher risk of default. Section 4. Predicting loan defaults. A practical example. In this section, we will walk through a practical example to understand how predictive models can be used in real-world scenarios. Imagine a borrower named Stella applying for a loan. She needs the money to start a small business. Stella meets with a loan officer to discuss her options and begins the application process. The Logit model considers her income, credit history, and other financial documents. It takes into account her income statements, credit report, and any other relevant financial information. Additionally, the model evaluates the loan amount she's requesting. Stella carefully calculates how much she needs and submits this information along with her application. The model then analyzes these factors and calculates the probability of Stella defaulting on her loan. This involves complex data analysis and statistical computations to predict her likelihood of repayment. If the probability is high, the lender may decide not to grant her the loan. This decision is based on the risk assessment provided by the model. Alternatively, the lender may offer the loan with stricter terms. These terms could include higher interest rates, shorter repayment periods, or additional collateral requirements. This helps mitigate the risk for the lender. By using predictive models, lenders can make more informed decisions, balancing the needs of borrowers like Stella with the financial stability of their institution. Section 5. Logit versus Probit, choosing the right tool. Now let's introduce the Probit model. It's like the Logit model's cosmic twin. Both models estimate the probability of a binary outcome, but they use different mathematical functions. While the Logit model uses a logistic function, the Probit model relies on a normal cumulative distribution function. The choice between them often depends on the specific data and the researcher's preference. Section 6. Beyond finance applications in diverse fields. The beauty of Logit and Probit models is that they're not confined to the financial cosmos. These statistical models, which are often used to predict binary outcomes, have found their way into a multitude of industries, each with its own unique set of challenges and opportunities. They have applications in various fields, from healthcare to marketing, from education to environmental science. These models are making a significant impact. In healthcare, these models can predict the likelihood of a patient developing a certain disease. For instance, by analyzing patient data, Healthcare professionals can identify risk factors and take preventive measures, potentially saving lives. In marketing, they can estimate the probability of a customer clicking on an ad. This allows companies to tailor their advertising strategies more effectively, ensuring that their marketing efforts reach the right audience and maximize return on investment. These models are versatile tools for understanding and predicting binary outcomes in countless scenarios. Whether it's predicting student success in educational programs, assessing the risk of equipment failure in industrial settings, or even forecasting voter behavior in political campaigns, Logit and Probit models provide valuable insights that drive decision-making and strategy. In environmental science, these models help in predicting the impact of climate change on various ecosystems, aiding in conservation efforts and policy making. The ability to analyze and predict outcomes based on data is revolutionizing how we approach complex problems across different sectors. The applications of Logit and Probit models are truly diverse and far-reaching. By leveraging these powerful tools, professionals across various fields can make more informed decisions, optimize processes, and ultimately drive innovation and progress.